Hey everyone, it's Ria, and welcome back to our channel Cash Roots. Now let's talk about securing your financial future. And no, I'm not talking about winning the lottery. I'm talking about building long-term wealth through investing. Now I know what you might be thinking. Investing? Isn't that just for people with tons of money and fancy suits? Absolutely not. Investing is for everyone, no matter how much experience or money you have. Whether you're starting with a few $100s or a few thousand, the key is to just get started. So, if you're ready to take control of your finances and start building a brighter future, then stick around. Because in this video, we're going to break down the top 10 investment options that are perfect for beginners in 2024. First up, let's talk about stocks. Now, when I say stocks, I don't mean the kind you find in your pantry. We're talking about owning a tiny piece of a real company, like Apple, Tesla, or even your favorite coffee shop. See, when you buy stock in a company, you're essentially becoming a part owner, a shareholder. Historically, stocks have delivered some of the highest returns compared to other investments. Over the long term, the stock market tends to go up, which means your investments have the potential to grow significantly. But, and this is important, remember that stocks can be volatile in the short term. The market can go up and down like a roller coaster, and that's completely normal. If you're just starting out, I recommend investing in low-cost index funds or ETFs that track the broader market. This way, you're diversifying your portfolio across hundreds of different companies, which helps to reduce risk. Alright, let's move on to our next investment option, bonds. Think of bonds like loans that you give to governments or corporations. When you buy a bond, you're essentially lending them money, and in return, they promise to pay you back the principal amount, plus interest over a set period of time. Bonds are generally considered to be less risky than stocks. They offer more stability and predictability, especially when it comes to your returns. That's why they're often referred to as fixed income securities. But here's the trade-off. Because bonds are generally less risky, they also tend to offer lower returns compared to stocks. If you're closer to retirement, or if you have a lower risk tolerance, bonds can be a great way to balance out your portfolio. They can provide a steady stream of income and help protect your capital during market downturns. Just like with stocks, you can invest in bonds through bond funds or ETFs. Let's talk about mutual funds, one of the most popular investment options out there, and for good reason. Imagine a group of investors coming together, pooling their money, and then hiring a professional manager to invest that money in a diversified portfolio of stocks, bonds, or other assets. That, my friends, is essentially what a mutual fund is. The beauty of mutual funds is that they make investing super accessible. You don't need to be a financial expert or have a ton of money to get started. With mutual funds, you can invest in a professionally managed portfolio with as little as a few $100s. Plus, mutual funds offer instant diversification. Instead of putting all your eggs in one basket by investing in just one or two stocks, mutual funds spread your money across hundreds or even thousands of different securities. When choosing a mutual fund, it's important to look at the expense ratio. The lower the expense ratio, the better. Chapter 4. ETFs. Like mutual funds, but cooler. Next up, let's talk about ETFs, or exchange-traded funds. Now, ETFs are very similar to mutual funds in that they also offer diversification and are managed by professionals. However, there are some key differences. Unlike mutual funds, which are priced once a day, ETFs trade on stock exchanges, just like individual stocks. This means their prices fluctuate throughout the day, giving you more flexibility to buy and sell. Another advantage of ETFs is that they typically have lower expense ratios compared to mutual funds. This is because ETFs are passively managed, meaning they track a specific index, such as the S&P 500 or the Dow Jones Industrial Average, rather than trying to beat the market. Just like with mutual funds, there are thousands of ETFs available, each with its own investment objective. So it's important to do your research and choose ones that align with your financial goals. Chapter 5. Real estate investing in bricks and mortar. Let's dive into the world of real estate. Now, when we talk about real estate investing, we're not just talking about buying your dream home. We're talking about acquiring properties for the purpose of generating income or appreciation. One of the most common ways to invest in real estate is through rental properties. You buy a property, rent it out to tenants, and collect monthly rental income. Over time, as property values rise, you can also benefit from appreciation. Another option is to invest in REITs, or real estate investment trusts. REITs are companies that own, operate, or finance income-producing real estate. They're kind of like mutual funds for real estate. Real estate can be a great investment, but it's important to remember that it's also illiquid. Chapter 6. High-yield savings accounts. Safety first. Let's shift gears and talk about high-yield savings accounts. Now, I know what you're thinking. Savings accounts? Aren't those boring? Well, they might not be the most exciting investment option, but they play a crucial role in any well-rounded financial plan. High-yield savings accounts are FDIC insured, which means your money is protected up to $250,000 per depositor, per insured bank. This makes them one of the safest places to park your cash. While high-yield savings accounts won't make you rich, they offer a much better return compared to traditional savings accounts. They're a great option for your emergency fund, short-term savings goals, or any money that you need to keep liquid. The best part? Opening a high-yield savings account is incredibly easy. Chapter 7. Robo Advisers investing on autopilot. Let's talk about Robo Advisers, the robots that are here to take over. Well, at least our investing. Don't worry, they come in peace. Robo Advisers are automated investment platforms that use algorithms to build and manage your portfolio based on your financial goals, risk tolerance, and time horizon. The beauty of Robo Advisers is that they take the guesswork out of investing. You don't need to be an expert or spend hours researching individual stocks or bonds. The Robo Advisor does all the heavy lifting for you. Another advantage of Robo Advisors is that they typically have lower fees compared to traditional financial advisors. If you're just starting out, or if you're looking for a hands-off approach to investing, Robo Advisors can be a great option. Let's talk about certificates of deposit, or CDs. Imagine this. You have some money that you want to invest, but you don't want to risk losing it in the stock market. You want a safe and predictable return. Well, that's where CDs come in. A CD is a type of savings account that offers a fixed interest rate for a set period, typically ranging from a few months to several years. When you invest in a CD, you're essentially agreeing to keep your money locked in for the specified term. Now, because you're committing your funds for a longer period, CDs generally offer higher interest rates compared to traditional savings accounts or money market accounts. However, it's important to note that if you withdraw your money before the maturity date, you'll typically incur a penalty. If you're looking for a safe and predictable way to grow your savings over time, CDs can be a solid option. Now let's talk about peer-to-peer lending, or P2P lending for short. P2P lending platforms like Lending Club and Prosper connect borrowers directly with investors, cutting out the traditional financial institutions. As an investor, you can browse through loan listings and choose which borrowers you want to lend your money to. Each loan has a different interest rate and risk profile, so you can diversify your investments based on your own risk tolerance. P2P lending can be a great way to earn higher returns compared to traditional savings accounts or bonds. However, it's important to remember that it also comes with higher risks. One of the biggest risks is borrower default. If a borrower fails to repay their loan, you could lose some or all of your investment. P2P lending can be a great way to put your money to work and earn passive income. Finally, let's talk about index funds, the OG of passive investing. Remember how we talked about ETFs earlier? Well, index funds are very similar to ETFs in that they track a specific market index, such as the S&P 500, the Dow Jones Industrial Average, or the Nasdaq 100. The beauty of index funds is that they offer broad market exposure, instant diversification, and low fees. Instead of trying to beat the market, which is extremely difficult to do consistently, index funds aim to match the performance of the underlying index. If you're looking for a set-it-and-forget-it investment approach, index funds are the way to go. They're the foundation of many successful investment portfolios. So there you have it, our top 10 investment options for beginners in 2024. Remember, investing is a journey, not a race. Start small, diversify your investments, and don't be afraid to ask for help along the way. If you found this video helpful, be sure to give it a thumbs up and subscribe to the channel for more videos on personal finance, investing, and building wealth. Thanks for watching. And remember, the best time to start investing was yesterday. The second best time is today.